Hey investor friends, I'm Michelle Markey, and today I'm going to be providing a small update and simplifying some of what I talked about in my original Recession by 2023 ? Video. And I'll be talking about the effects of monetary policy and fiscal policy stimulus on our economy and the stock market, and what it means and what you can do about it, and why I think we could be having an inflating of an everything asset bubble. And I've got two indicators that I'm tracking as to what could lead towards an eventual bubble bursting and what will actually burst that bubble, and why we will have maybe a legit recession by 2023. Before we talk more business, I want to wish you a happy Mother's Day this Sunday. And if you're a mom or have a mom or a grandmother and you want them to have financial security, I'd love if you could please like and subscribe, because it helps out my YouTube channel and lets me know that you're interested in the personal finance and investing topics that I'm working hard to educate you on, so that you can be the best investor you can be and help spread that wealth to your own loved ones. Thanks. As we all know, the coronavirus pandemic forced world markets and global economies to come to a grinding halt last year, and it made world governments and central banks have to intervene to try to revive the economy. Like the US gross domestic product fell by 3.5% when normally we grow by 2 to 3% per year. So because of this shock to our economy, it made the Fed and Congress take certain actions so that through the powers of monetary and fiscal policies respectively, our economy could go back on track, and so could the rest of the world through their own respective actions. And because it looks like the stock market has been hitting all-time highs recently, it's led some articles like this Bankrate article to ask, could we be in a stock market bubble? And what are some of the conditions that warrant for a bubble? And also pointing out that maybe people are just really optimistic, and it's easy to suggest that people are just being carelessly optimistic and therefore, of course, we're in a bubble. It's maybe not that simple, and maybe people are just being really positive because they expect the US and world economy to really get going this year. And that's why maybe all of the stock prices are warranted for what we're expecting the economy to put out. And nevertheless, whether the party is continuing on or things are totally rational, the best investors in the world still maintain their cool and try to recognize when it's a buying opportunity and when we should be treading carefully. And that Bankrate article talks about how there have always been Bubblicious stories that captured the market's imagination. And they include how in the late 1990s we had the dotcom bubble with the internet changes everything, in the 2000s with the housing bubble, in real estate never goes down, and that eventually led to the great financial crisis or the Great Recession. And in the 2020s, I think we have the electric vehicles, crypto, housing, big tech, and everything bubble, or everything always goes to the moon or Mars. And I just made that one up, but it kind of shows that I think that we're in a crazy place. And you could be watching the stock market's major indices like the S&P 500 hit all-time new highs and think that the government's interventions since March 2020 have worked and our economy and the stock market is back to normal. But actually, there's still a lot of suffering going on. Our unemployment is still higher than what the Fed would like it to be. And also our inflation level is not yet at the Fed's target. And I'll get more into that soon. But just because the government has intervened and taken some measures to stimulate our economy, that doesn't mean that everything that's going well in the stock market is necessarily a reflection of the broader US economy. So for example, the real economy is not necessarily equal to what's happening in the stock market, because the government's priority is to make sure that our gross domestic product or GDP is getting back on track after having declined so much last year. And it also wants people to be more fully employed in what they consider max employment. And it doesn't mean that there will be 100% employment, but that there will be enough employment that it shows that the economy is strong enough, and that we also have inflation at a rate that's acceptable and that it's not overheating the economy. But often a lot of people will associate the stock market going up with the idea that everything is well in the economy, when the stock market's indices like the S&P 500 only has 500 companies in it. So even though it's a good measure, it doesn't reflect the over 30 million businesses in the US. So what's really happening in the real economy could be very different than what we see happening in the stock market. Given that we had such a shock to our economy last year, the US government had to do something. So let's take stock of the actions to date, and through the powers of the US Congress and President, the actions that they were able to take were in the form of fiscal policy, where the US government is trying to manage aggregate consumer demand through spending and taxing actions to stimulate the economy and business activity. And this can be in the form of tax cuts or rebates, where a lot of people have gotten stimulus checks, or in government spending projects like on infrastructure projects that offer employment opportunities. And when the government doesn't have enough revenues to do this from taxes, it does what's considered deficit spending, or issuing debt in the form of US treasuries that get sold to foreign governments and other institutions so that the US government can afford to do all these stimulatory effects. And if the government wanted to slow down the economy, it would increase taxes or reduce spending, but that's not what's happening now. And instead, the US government has focused on as much stimulus pumped into the US economy as possible. And there were 5.5 stimulus and relief packages from March 2020 through March 2021 that totaled $5.6 trillion that were intended to help the everyday American people to revitalize the economy. And it actually had another effect in the major first one of the CARES Act of $2.3 trillion. When that one came out, it had the effect of restoring investor confidence and making the stock market skyrocket, because as we see here on March 23, the S&P 500 hit its low last year in 2020. And then when it was March 24, people started thinking, oh, we might pass an actual stimulus bill to help out the economy soon. And then as soon as it passed by March 25, the S&P 500 hasn't looked back since. To do its part to stabilize the US economy, the US Federal Reserve has some key tools to manage interest rates and money supply and circulation. And from March 2020 to March 2021, it added $3 trillion to its balance sheets. And I'll get into what exactly that bought. You see, the Fed uses its monetary policies to achieve its dual mandate goals, which are 1, maximum employment, and 2, price stability and moderate long-term interest rates. And these are measured in the form of an unemployment rate, and ideally it's somewhere around 4.5% according to the natural rate of unemployment that the Fed tracks. And the other one being inflation, where the ideal target is 2%, and recently the Fed has said that they're okay with if it goes a little bit above 2%, as long as the economy is kicking into full gear. But those are the two main numbers that the Fed aims for in achieving this dual mandate. And right now, from recent figures that I've seen, as of February 2021, it's been at 6.2% unemployment and 1.6% inflation. And I think our unemployment as of April 2021 went a little bit lower, like around 6%, but we're still nowhere near what's considered full employment. So that's the biggest priority of the Fed. With adding that $3 trillion to its balance sheet, the Fed has done a liquidity injection and slashed interest rates to near 0% to make it cheaper to borrow and to spur consumer spending. And the Fed is continuing to keep this up by buying $120 billion a month worth of US Treasury bonds and mortgage-backed securities. So by taking this expansionary action, this is known as being dovish and also known as quantitative easing. And that's caused the Fed to have $10 trillion of assets on its balance sheet, and that includes $7.8 trillion of US Treasury bonds and $2.2 trillion of mortgage-backed securities. And this is because, like I said, the Fed wants to encourage consumer spending and it may lead to inflationary effects. Whereas if the Fed wanted to slow down the economy, they would start being hawkish and start tightening by doing what's called quantitative tightening and increasing interest rates in order to control inflation and avoid overheating the economy. But unfortunately, that may have a deflationary effect, whereas by being dovish or doing QE, that's having potentially an inflationary effect. So by implementing these monetary policies, the Fed is projecting that we'll have ideal target unemployment rates and inflation rates by 2022 and 2023. And by that time, the Fed would likely believe that the US economy has fully recovered, that it's strong, people are back to work, and taxes are rolling in. And recently on 60 Minutes in April, when Fed Chair Jerome Powell was asked about if the amount of fiscal spending will be a match to inflation, Jerome Powell responded that he doesn't think that our current fiscal spending is on a sustainable path and that eventually it'll need to be reined in because even though it's serviceable now, it's not sustainable for our government to keep spending as much as it does. But he didn't really want to give advice to the fiscal side of the house because his responsibility is just monetary policy. See if you notice a pattern in the following clips I'm about to share. And back in September 2020, Jerome Powell assured people that we will have low interest rates most likely through 2023. And even when bond yields in the markets were starting to rise up in February and March 2021, that didn't really bother Jerome and the rest of the Fed. They were like, it's okay. We're in no rush to increase our interest rates in the federal funds rate, which is the rate that it lends to other banks, because you can think of the Fed as the banker's bank. So they're in no rush to increase the official rates, but that's to the consternation of people in the bond markets because they're probably getting pretty frustrated with bond yields being as low as they are as a result of the current low interest rate environment. And then in late April, we're still just holding steady as the Fed hasn't changed their mind and they're likely to continue keeping low interest rates for the foreseeable future. And that's despite maybe some signs that the economy might be overheating in the form of a higher stock market, or maybe inflation is increasing faster than we might expect. But nonetheless, the Fed is holding on to their convictions. So where does this low interest rate environment leave us? It's with the stock market and other assets increasing in their prices because all that monetary and fiscal stimulus money has to go somewhere, and a lot of it's probably going into the stock market and all kinds of assets, as we can see with lots of things increasing in their prices. And this is what's led to me thinking that we're in an everything bubble. And what comes next is in the territory of clouds moving along where we're not sure if everything is fine or if there's about to be an economic storm ahead. So take some of the indicators that I'm talking about with a grain of salt, because they may be foreshadowing bad things to come, or maybe everything's just fine and sun will appear with rainbows at the end. Sometimes the financial indicators I'm about to talk about can be useful to signal the health of the overall stock market or the economy and how it's doing and whether it's likely to continue performing that way or not. And I find it ironic that the rocket man Elon Musk himself recently asked Cathie Wood of ARK Invest what she thought about what I think he was referring to as the Buffett indicator, but he called it the S&P ratio to GDP, and he was really referring to the Wilshire total market cap, but Cathie understood what he was talking about. And in a whole Twitter thread, Cathie responded to Elon by talking about how in the late 1800s and early 1900s, that the total equity to GDP was actually much higher back then due to the advent of electricity, telephones, and cars, and that it was greater than it is now, but that a lot of people who analyze technical trends tend to use post-World War II for economic data and stock market data. So she was trying to see what the validity might be of what's considered to be the Buffett indicator. So who knows what she'll find out, but I'm going to explain what I've learned about the Buffett indicator so far. So the Wilshire 5000 Total Market Cap Index to Gross Domestic Product, or Wilshire GDP for short, is Warren Buffett's favorite indicator to assess the health of the stock market and how it's performing relative to the US economy. And as we see here, the Wilshire GDP has recently skyrocketed to 235% of GDP, which is incredible. So I put this face here of shock and awe in that I thought it was bad when we were in Q4 2020 at 216% of GDP and the market cap was at $46.6 trillion. But now we're at a market cap equivalent to about $51.8 trillion in Q1 2021. So that means that while GDP only increased by 2.65% from last quarter to the most recent quarter, the total market cap has increased by way more of 11% of an increase. So what this means to me is that the market has become insanely expensive, as you can see with the lines I've drawn, in that we're really overpriced in equities that we might want to buy, whereas if we were below the 1.0 mark where I've drawn in red, then that means that securities would likely be much cheaper and affordable to buy. And below this 1.0 mark is usually where Warren Buffett would like to scoop up wonderful companies on sale. That's what I'm waiting for, is this market to cool down so I can also do what Buffett normally does. The other indicator I keep tabs on is the Robert Shiller cyclically adjusted price to earnings ratio, or also known as CAPE, for which Robert Shiller won the Nobel Prize in 2013 for economics. And this CAPE ratio shows us how pricey equities tend to be according to this use in the S&P 500, where a couple of months ago I saw this ratio being at 34 and recently it's been over 37. So the only other times that we've been up at these levels was right before the Great Depression in 1929 and around when the dotcom bubble burst. So this is not great territory to be in if we think that everything's normal in the stock market, because the historical average of the stock market or S&P 500 performance is really closer to 15 or 16 of a ratio. So knowing that asset prices are really expensive and the Fed bowing to keep interest rates low till 2023, which effectively signals to the stock market that, hey, keep partying on, there's no need to be worried about anything. That makes me want to do some Google doom scrolling, where I'm Googling whether we might have a recession by 2023, and even I pop up in the results. But really then I check out some articles that give me some assurance that I'm not the only one who's thinking this, in that there have been some economists who, even before the pandemic hit, were already projecting back in 2019 that we might have a recession by 2023. Or looking at Harry Dent's articles, he talks about how we'll have a stock market bottoming by 2022 or 2023, and it'll be the biggest drop that he's looking forward to in his lifetime. And who knows who's really right, but it helps to be a little bit cautious no matter what. I'm going to take a wild guess in what will lead to the bursting of the stock market and everything bubble, and that's the Fed finally raising their federal funds rate by 50 basis points or 0.5% or 0.5%, according to economists who are projecting that that's when the Fed will raise the rates. And why I think that this is going to burst the bubble is because it's converging on a few trends and also achieving a few goals that the government had in mind all along. So by the time the economy is stronger by 2022 or 2023, we see that unemployment rates will be lower and inflation will be at the rate the Fed wants. And then conveniently, the Fed will also then raise their interest rates. And that's why I think that the stock market will finally get into check based on the Fed taking these actions after all of this time of Jerome Powell just sitting put. We have historical precedent of when the Fed raises interest rates and starts reducing assets on its balance sheet when the US economy looks like it's on solid footing. And even in September 2018, the Fed raised its interest rates and the stock market didn't like it and proceeded to tumble for the rest of Q4 2020. So we didn't have a Santa rally that year. And then when we had the coronavirus shock in 2020, the Fed slashed interest rates to near zero. And then what did we see? Stocks or stonks skyrocketed to the point of where we are now in spring 2021, where I don't see any reason for this to end anytime soon. I actually think that the party will still continue on until maybe we might hit 5,000, because there's something magical about this 5,000 number that psychologically maybe something will happen. Who knows? I'm just playing around with numbers, but we'll see what human behavioral psychology plays out to be like. And then the Fed may finally raise interest rates by 2023, causing the shoe to drop on workers and corporations. And when debt is more expensive because interest rates are higher, then most likely corporations and the US government will finally have to start addressing the amount of debt they have in a more serious way. And then this might cause stocks to actually come back down to earth a little bit, since they've had it so easy living off cheap debt for so long. So then, much like my investor idols Warren Buffett and Charlie Munger, I'm looking forward to hopefully an opportunity to buy wonderful companies on sale, and hopefully our economy will still be intact and not damaged too much, but just that stocks can hopefully be more affordable, because I kind of feel like at these nosebleed prices, they're not reflecting their value anymore. So I'm waiting out to see what will happen, and what you can do until that time is keep doing what you've been doing. If you're an index fund investor, you can just keep doing that if you like investing in index funds. I like to sit in a lot of cash like Warren Buffett is doing, and waiting for the time when certain companies are at a price that I'm willing to buy them at. So I'm waiting until it's my time to jump in, but you don't have to. You can do what feels right to you. And otherwise, if you're not sure, I just encourage you to keep studying how to be the best investor you can be. And I'm biased because I think that the way Buffett and Munger invest is the right way to do it, but to each their own. And I'm curious what you think. Please let me know in the comments below if you have any thoughts about this. Do you think we're headed for a recession in a couple of years? I'd love to hear from you. And if you enjoyed this video or learned something, please like and subscribe. And I wish you well on your journey towards financial freedom. Till next time.